Welcome to our exploration of the basic concepts of income tax in India. Income tax is a direct tax levied by the central government, and understanding its administration is essential for anyone dealing with finances in India. The tax is paid by individuals and entities on the income earned during the previous year, and the process is governed by the Income Tax Act 1961, along with the Income Tax Rules and the latest Finance Act. In this video, we'll break down the broad mechanism of income tax, key definitions, and the structure of how income is assessed and taxed. Whether you're a student, a professional, or simply curious about how income tax works, this overview will give you a solid foundation. Let's start by looking at how income tax came into being and how it is administered today. Mechanism of income tax in India has evolved over time, starting with its introduction in 1860 due to financial needs after the First War of Independence. Over the years, several acts and amendments have shaped the current system, with the Income Tax Act 1961 being the cornerstone. The Central Board of Direct Taxes (CBDT), under the Ministry of Finance, is responsible for administering the act and framing the rules. Every year, the Finance Minister presents the budget, which includes the Finance Bill. This bill, once passed, becomes the Finance Act and sets the tax rates for the year. Income tax is levied on the previous year's income at rates specified for the assessment year, and the Act identifies 5 heads of income: salaries, house property, business or profession, capital gains, and other sources. Understanding these categories is crucial for accurate tax computation and compliance. Navigate income tax. It's important to understand some key terms. The concept of income is broad, covering profits, dividends, allowances, capital gains, and more, as outlined in Section 224 of the Act. Not all receipts are considered income, only those with regularity and a definite source. The term person includes individuals, companies, firms, associations, local authorities, and even artificial juridical person. Anyone liable to pay tax is termed an assessee, which also includes those responsible for deducting tax or entitled to refunds. The permanent account number PAN is a unique identifier for every taxpayer, essential for all tax-related transactions. These definitions form the backbone of the tax system, ensuring clarity on who is taxed and what is considered taxable income. Income tax assessment in India revolves around 2 key periods: the assessment year and the previous year. The assessment year is the 12-month period starting from April 1, during which income earned in the previous year is assessed and taxed. The previous year is the financial year in which the income is actually earned. There are exceptions where income is taxed in the same year it is earned, such as for non-resident shipping companies or individuals leaving India. Understanding these periods is crucial for compliance, as they determine when income must be reported and taxed. The system ensures that all sources of income are accounted for uniformly, and special rules apply for new businesses or sources of income. Concept of total income is central to tax calculation. Total income is the sum of all taxable income under various heads, after allowing for deductions such as insurance premiums or provident fund contributions. The method of accounting, cash accrual or a mix, determines how income and expenses are recognized. The Income Tax Act allows taxpayers to choose their accounting method, but changes require approval from the assessing officer to prevent manipulation. Once gross total income is calculated, deductions are applied to arrive at the total income, which is then taxed according to the rates set in the Finance Act. This structured approach ensures fairness and consistency in tax administration. In summary, understanding the basic concepts of income tax in India involves knowing the structure of the tax system, the key definitions, and the processes for assessment and calculation. The Income Tax Act 1961, along with the rules in the Finance Act, provides the legal framework. Key terms like income, person, assessee, assessment year, and previous year are foundational. Total income is calculated after considering all sources and deductions, and the chosen accounting method plays a significant role. Staying updated with changes in tax laws and rules is essential for compliance. With this knowledge, you are better equipped to understand your tax obligations and navigate the Indian tax system confidently.